Now, before we kick off segment 2, we'd like to remind you, please like, share, subscribe. We've had a lot of support recently. We really want to keep that going, so thanks again. When we turn over now to the product side, this is just a quick summary. So when we look at current, what came out this past week, we had a U.S. product demand of about 13.625 million, which is much greater, obviously, versus last week, which is that 12.873, which, again, we thought was way too low given where we were sitting in the market. Now, the average right now sits at about 13.351, and this is getting close to where we think we're going to hold as we go through the remainder of February into early March. And it's getting closer where we're thinking about 13.4 is 13.5 is really that right number, because the jet fuel helped juice this number. We think that pairs back. We think gasoline still is really going to make up for whatever jet fuel added. So that's where we're going to get gasoline support, and distillate, again, demand is going to remain fairly strong, or I should say very strong at this point, through the remainder of the month as we have additional flow through coming through on the trucking side, which we'll talk about in a minute. So when we look at the distillate stock draw, so we had a draw of about 1.73 across the whole entity. It's still up on a year-over-year, 5-year average, but again, we're starting to turn down. And the unfortunate side is the slope is still wrong, where we still are remaining elevated. Even though we're drawing down, you can see that on the average, we normally draw down this time of year until about April. It's just we're not seeing the same type of pull through that we should, even though we have a weather event across essentially most of the United States that should help heating oil. And that speaks to replacements in terms of people using natural gas, using electricity, which we'll talk about actually in the economy show, as well as the propane. So you've lost some market share, but on the other side, we still have a significant amount of trucking moving through the system, a lot of pull through that is maintaining a lot of that diesel movement. So you can see a lot of the draw was really created by Pad 1 with a draw of almost 2 million barrels. And that's something that we expect to continue and in terms of draws, where we think that there's going to be a continuation of these pull-throughs, but it just will be muted in terms of where we normally see it on a seasonal basis. Now, imports dropped 162,000 barrels a day, but you can see that even though it dropped, we're still well over the year-over-year 5-year average. And based on the reversed arbitrage now still open and getting wider, we're actually going to have a resurgence of distillate coming from Europe into the U.S. So you can see that we never really dipped too far down, but now we're actually going to build back up over the next 6 weeks as these boats continue to appear and replenish what was already taken on the coast. And again, Pad 1 is going to be the big receiver of that, so it'll be one to watch. Now, when we look at demand, we were expecting to see it fall a little bit along that seasonal average, but still maintain that elevated level across the top of the range. Instead, it just went higher. We're now at a seasonally adjusted high going back over the last 5 years. Again, there's really a lot to support that as we look at trucking, as we look at rail, as we look at some movements within the industrial system, because we still have a lot of bottlenecks, which we'll talk about on the coast, that need to work their way through. It's starting to normalize. And in the economy show, we'll talk about inventories, how inventories are starting to get back to a balanced level. But again, these are things that are still not there yet, and that's going to keep this supported, as well as heating oil demand. So this is capturing a lot of components that will be supportive through the next few weeks. And when we talk about internet, the trucking demand through Internet Truck Stop, we were saying that 105 to 115 is the right number, or within that range. And we said that if we had another big increase, and then based on what the data was telling us, we'd have to take that higher. Well, here we are. We're taking it higher. Here, we're really moving closer to about a 115 to 125 over the next few weeks. as we see some of this pull through, just because the demand for trucking remains robust. If you look at load availability, if you look at truck availability, it's still fairly stable, but with a lot of loads starting to come into the market, this is obviously going to help pull through and maintain that elevation, even as the truck pricing, when we look at rates, stay fairly flat. Now, we're expecting some of these rates to start to go higher as diesel prices are increasing, just based on the push, with feedstock going up. When we think of oil prices, refiners are just trying to make a spread in between, but they have to increase prices on the other side as well. So as feedstock prices go up, so do the actual refined products, where when we look at gasoline prices, we're now back to pre-pandemic levels. When we look at diesel prices, we're back to pre-pandemic levels. And again, that's where we're starting to see some of those inflation numbers come in as the base effect takes hold. And there's going to be that push that's going to impact people who may not have that money available, or will start to reduce a bit just to try to avoid some of the increased costs that we're starting to see come into the market. Now, but again, when we look at trucking, we also have to talk about rail, and rail remains strong. So when we talk about where things are, we said intermodal was going to slow a bit versus last week. Again, it slowed a little bit, but still staying within that. As we were saying, that 5 to 7%, we were a little bit over the 7%. Here we're at 6.4, so right within that comfort zone. There's a lot of movement to support that when we're thinking about intermodal, just as we have cargoes coming on the coast that need to get through the system. Pad 5 or California starting to loosen up a bit in terms of COVID restrictions, which will help accelerate some of the bottlenecks at the port side, which will move through the system, keeping some of this elevated. Now, going through the different components, chemicals is going to stay fairly strong versus where it was last year, just given the activity that we're seeing at the chemical side. Coal is going to stay weaker, but obviously grain is going to stay north of 20%. We have exports going off very strong. We have additional increases, which we're actually going to talk about in segment 1 of the Econ Show, talking about why we think grain is going to remain elevated. Motor vehicle, there's a lot of hiccups when we're talking about some of the supply chain, especially on the semiconductor side, which I actually talked about on another podcast with Ryan of the War Room. But when we're going to touch on just how tight that market is and why there's going to be some slowdowns on the vehicle side, which will continue through the system. Petroleum products, again, it's going to be weak just because we still have way less demand than we did pre-pandemic. So that's still going to remain until we start getting into March, where the March effect is going to happen, or the COVID impact, which will start to take that higher. But again, we're still going to be light when we start thinking about where we normally are at this time of year. But net, intermodal is still up. Total car loads is still down, but that gap is closing. So total traffic still remains elevated, and we still think that that's going to be a fairly consistent capacity through the remainder of Feb. Now, when we look at Signal, and this is a free thing that you can sign up for, it's been very, very good. But when we look at import volumes, the import volumes they start out elevated and then they get whittled down as the delays remain at the port, kicking things further down the line as the anchorage, in terms of where are we going to be at this point in time. So we had import volumes drop on the Feb 21 to 27, just because, again, just the delays, which means that they're going to have to offload in March. And then Feb 14 to 20, it gets backed up into the end of Feb, and you kind of see how this goes, which is why when we look at the change on Feb 7 to Feb 13, the change from previous week was down 6%, even though when we first posted this, it was up. And then change from previous year, that's going to remain elevated just because trade was so slow, and now that we still have to try to rejuice and rejigger the supply chain, it's going to support some of this activity, and this is coming into the LA port. Now, this should help to alleviate some of the problems as we start to see Pad 5 open up, but again, this is still going to support rail and truck movements in the near term. This is just looking out over the next 8 to 14 days. You can see that we're still staying cold, and it's in areas that are colder than normal. So you're already seeing a lot of pain on. If you look at Feb 8 and to Feb 9, you can see, and obviously this is projecting forward. You can see that we're still in some significant cold, which is obviously going to pull through more heating demand, more propane demand, and that's going to be supportive through the remainder of February. So when we look at gasoline, we had a big build of 4.26 million. It was really driven by Pad 1. Again, that was also due to the snowstorm. So we will see a makeup number where now that the snow is melted, things reopened. They'll move the gasoline again out of storage to the rack to the end user. So that will accelerate in Pad 1. But Pad 3 had a build of 2 million, which again is because the focus has shifted to summer grade. And the way we track summer grade, or the best way to track summer grade, is looking at blending components. So when we look at blending components, because the mix of gasoline changes winter into summer, and here you can see that now on the blending component side, we're about 3 million barrels over the 5 year. We're still 1 million barrels below the year over year, but just based on the rate of change that we're seeing, and just by looking at the chart on storage, you can see that we're accelerating. The pace is going up and up on terms of the slope, as we should start to be rounding out and starting to see some draws if we look at the average number. Instead, we're going to continue to drive higher. We're now right in line with the 5-year average. We're still down 4.6 million versus the year over year. But if you look at the change week over week of 4.26, the year over year change still down by 4 million. I mean, we can make this up within a week or two, and then we'll be back above not only the 5-year but also the year over year. And imports will start to drop. They'll still remain elevated, but again, we're starting to see the tightness in the gasoline spread, even though the diesel arb is open. This is tightening a little bit. So again, it'll just slow some of those imports, but it won't stop them. It's just, we're going to start to see a fairly steady flow, and it's still elevated year over year and 5-year, just because driving still remains weak within Europe, which we'll talk about in a minute. Then when we look at the U.S. in terms of supply data, demand was at about 7.857. We think it's going to come in closer to 8.2. 8.1, 8.2 is going to be where we think this is going to normalize. Again, there's just a lot of timing delay with getting to that level, but you can see that we're going to close that gap as we start to move higher, and we're just going to hang around the lows of that cloud, which is from 2006 to 2020, just to give you an idea of where were we during other downtimes and weak economic periods, and you can see that we're still well below that, and price increases at the pump won't really help us adjust that over the longer term. Then, and it's always important to appreciate what does the activity look like in the U.S. So we do have COVID cases slowing. We have COVID deaths that are staying elevated, but again, the cases are slowing, hospitalizations are slowing. We have an acceleration of vaccines. These are net positives when we consider what is going to happen to the market in general. But when we in the econ show, we're going to look at truck sales, home sales, and how we've already seen a lot of individuals purchase cars as they moved into the suburbs, and that happened from March and continues to happen to today, but it's obviously slowing due to weather. But even though we saw these new cars coming to the market, and for the most part, a lot of places are open, and we're seeing an extension of indoor dining. Going to stores by me, everything's fairly normal in terms of levels of occupancy. But again, the people that moved, they have a different means of communicating and buying and doing just daily activities, and a lot of it is online. A lot of it is not going to the store, but really perusing online and getting things sent to your home. So again, those are things that are going to kind of offset some of these moves to the suburbs. But when we look at the lockdown index, That's going to continue to trend lower. We're now below 70. It hasn't been updated in the system, but just by our calculations, it's closer to 68. And we should be close to 63, 65 really by the middle of February as some of these adjustments roll through. Jobless claims remain a problem, which again, speaking to activity, jobs, money, wages, driving, that's going to be the longer term problem that we'll talk about in the Econ show. So this is also looking at that Dallas Fed mobility and engagement. You can see that we're still well within the range that we've seen of about down 23% to about 55%, depending on what period of weekday versus weekend. One of the things that we said last week was that the weekends are getting more engaging, where we're seeing a bit more activity on the weekends, and we were seeing some increases on the weekdays, and you can see here on the right the U.S. mobility and engagement. Weekends saw that nice little uptick. Now it's starting to kind of flatten out at this level, so we realized about an 11% gain. And then weekdays are starting to normalize closer to pre-holiday levels on just the mobility level, mobility and engagement. But when we look at residential mobility by states, you're starting to see that flatten out. Workplace mobility by states, again, flattening out. So when we think about workplace mobility, that's going to speak to weekdays on who's driving to work, who's going to work. That's going to, again, creating this kind of flat line at about a down 50 to 45% versus previous. And then the weekends, based on the residential activity, you can kind of see how, based on some downward trends in some regions and some flattening, slight increases in others, is going to keep that weekend side at about down 20% to 18% versus normal, which again is speaking to those swings in between. And this is just more proof of what we're talking about. When we look at the activity levels, you can see grocery and pharmacy stores slowing down. You can see retail and recreation slowing down. Workplaces right back to where it was, even a little bit higher than pre-holiday levels, again, as we start to see some opening up. So there's that shift from recreational, grocery, pharmacy, retail shopping to workplace. And again, there's just less on the weekend, a little bit less on the weekends, or at least stable on the weekends, and a little bit of an increase on the weekday side. And Apple's confirming a lot of what we're talking about. We're getting a little bit additional movements in Italy. You can see UK still down, Germany still down, and that's going to be a little bit of a cap as we go into the remainder of the month. And now we're just looking at what is going to. Something came out with Macron, and I want to see if he was talking about lockdowns, which so far they have not talked about or increased any needs for lockdowns at this point in time. So then when we shift to the COVID, because where would we be if we're not talking COVID? Here you can see daily tests are starting to come down. Obviously, cases are way down. Currently hospitalized, again, way down. Deaths are still elevated, but again, following that trend, because cases go before hospitalizations, go before deaths. So we're starting to see some of those, this positive movement, which again will reopen a bit more, get people a bit more confident that they can go out into the world, which is why we remain a bit more on the bullish side on gasoline, getting back to the bottom of that cloud. Now, when we go abroad, some of the highlights that we're seeing is obviously worldwide cases stay fairly flattish. Europe is starting to see some reductions, but the benefit of what we're seeing is India continues to see a slowdown in cases. Japan is seeing a slowdown in cases. South Korea's not seeing what they want to see, which is a bit of a problem. But more importantly, and the two that we're going to focus on, is Germany saw a big drop-off and India continues to see a drop-off, which is a net positive for two very strong countries on the export side and just activity that, and especially on the German side, that you want to see some of that pull through. They're supposed to have a lot of their lockdowns expire in April. We'll see if some of this, the speed at the drop in cases, if that accelerates things a bit, where instead of it being in April, maybe it's end of March. But again, this is net positive when we're thinking about activity on an economic level and refined products level. So then when we look at vaccinations, this is a little bit of a headwind to Europe, because Europe is struggling to see that acceleration. Using the log scale, you can see that they're really starting to flatten out and actually turn a little bit lower, just because they're just struggling with getting this into the market where the U.S. is seeing some solid acceleration. And then the question is going to be, first dose versus second dose. What is the right metric? And here you're seeing that there's a lot of individuals getting there and accelerating really in the U.S. UK remains on a strong track. So based on this rate, as long as we can continue to see some acceleration, the hope is by the end of this year we'll start to see some of the vaccinations reach a level where you're just going to get an activity boost because you'll reach herd immunity. Now on the jet fuel side, we had a small draw of about 500,000 barrels. That was driven by Pad 1, Pad 2, Pad 5. And you can see just looking at the demand side, we did get a big spike, and it's still obviously well off the 5-year average, but it's back within the cloud. It took out the high that we saw in January. And it's interesting because we sometimes see this normally happen as we get closer towards spring break, winter break, and you start to see some additional pull through of activity, but we're really not seeing that when we look at flights and just bookings and whatnot. So this is something where we're expecting a pretty sizable move back lower. Not really going to take out those lows, but just move back to the lows, because we still think that you're going to get between that 750 and 1,000, 750 and a million, or 750,000 and a million, in terms of where we think there's going to be that comfortable range for demand. And the reason why we say that is because we do have a little bit of an adjustment higher as we see some flights coming back in China. And this is, when we're thinking about where we are, we saw about 5,000 flights getting canceled from China. So to see 400 come back is not crazy as we start to see some adjustments. The U.S. has a little bit of an increase. Again, this also could have helped the reasoning for pulling through more jet fuel as we have some more departures. But when we look overall, there were some 580 more departures on average each day, as we talked about here, and as BNF has mentioned. But almost 1/5 of flights scheduled to depart this week in China have been cut since last week, obviously due to holiday restrictions. And elsewhere, flights scheduled for March are beginning to be cut, as is normal, 2 to 3 weeks ahead. And just to put that into context, some 3,300 flights have been removed from March since last week. So again, this is why even though we did get that spike in demand, we don't see that remaining, and that will start to pare back, especially because we didn't see any movement in passengers. As you can see, we're still staying between that, that 550, 800 level, and it's gotten a little bit higher, in terms of where we're staying out. But again, we're not really breaching that high, which is really getting to about 800, 850, but then that low of 500 remains fairly firm. So we're just waffling within that. And as you can see, last year, there's a little bit of a pickup that happens this time of year, again, coming to when is the timing of spring break and activity, but we're just not seeing that this time. And when we talk about China, I think it's important to look at the drastic drop in people traveling. And just to put it into context, when we look at 2019, so we're expecting, and the estimates, which we believe is correct, are down 30 to 40% versus 2019, but then up about 10% versus 2020. And so far, it looks like it could even be a little bit lower and to the lower end of that scale. But again, we're just seeing just how low activity is heading into a very big driving and flying and holiday season within China, which will put a lid on some of the near-term demand coming into China itself. Open table, not much to say or has changed. We're still pretty tightly in this range. But as we go into the next few weeks, we're seeing some increases in allowances on the state side. So like New Jersey took it from 25% to 35%. New York City is going to 25%. You're seeing some expansions to 50% in areas. But just to be clear, for anybody that's been by a restaurant, they were already doing it. So all of the state is just reactive, not really proactive in terms of what their allotments are. So that's why we just think that we're going to maintain this level as we go through the remainder of February. And here's where we see some increases. So on the weekdays, we think we're going to hold that 60 to 65. The one benefit that we're going to see is going to be on the weekends, where we're going to see a little bit more activity, where instead of it being where it has been at, like, let's say between 50 and 55, we think it's going to be closer to 45, 50 down below last year. And you can see that playing out in the U.S. UK still shut, Ireland, Germany still shut. Canada is starting to see a little bit of loosening, same with Mexico, but it's really in line with where the U.S. is. So that's where we're going to see the global activity kind of stay. So, in summary of what we've talked about, there's a whole lot of just sideways. And the sideways is really being driven by gasoline and diesel, where they're just kind of sharing on who is picking up some of that demand slack, where we're continuing to see a push through the distillate side. But given the demand in diesel, given the demand in heating oil, you would have expected to see a little bit more coming out of storage, which is speaking to where is the kerosene going? Is it already starting to go into the distillate cut? Where are some of these adjustments being made, which again is keeping distillate stock elevated, especially given there's very limited demand for our disti in the export market, which we'll talk about in the next segment.